Hello, Mavericks squad members and anyone else that may be watching this by the time I have released it. Hope you're all doing very, very well. Welcome back. Today, I'm just giving a quick note video. Okay, so a video with some annotations over my thoughts and what I do. Topic of today's technical signals that I watch. Now, I'm not a technical analyst by any means. It's just something that I hold in the back of my mind as an extra indicator, an extra input into my thought process, particularly when trading options. Okay, I'm much more active with them than normally when I just buy equities or any other investments. It's a longer term, hopefully more value investment framework. Disclaimer, of course, nothing I say here or in any other videos is advice. It's just what I'm doing with my money that I take care of. My opinion, that's all it is. Nothing here is advice. So don't take it as advice. Go and seek an appropriate professional. I'm not a professional. I'm not qualified to give advice. That's why I don't give advice. This is an opinion. Hopefully you got that. All right. Housekeeping out of the way. So technical indicators, there's heaps of them. I really only look at 3. And as I say, I don't take them all as gospel. I just use them as part of a broader group of inputs into my process. So the first one is a 200-day moving average. This one's, I think, probably the easiest and most straightforward to understand. It's a moving average of the closing price of a given asset, typically a stock, over the last 200 days. Okay, so at the end of the day, the closing price over 200 days, the average of that, and you can plot it over those 200 days. So it'll move as the average closing price goes up or down or moves. Okay, pretty straightforward. Moving averages would vary in their duration depending on what the trader wants. So you might see a 12-day, a 20-day, a 50-day, a 100-day moving average, and people look for crossovers and all this sort of thing. For longer term plays, 200-day moving average is probably the one I use most. Sometimes I'll look at a 50-day versus 200-day to see if we're getting a crossover in either direction. But generally speaking, 200-day moving average, if a stock retraces, a stock that I've done fundamental work on and I just have a fundamental opinion on its direction, then when it comes back to hitting that 200-day moving average as a support line is often a good time to add to my positions. And I know that a lot of other people out there do the same thing. Scott from So and Reap Capital, who's been on the channel, he talks about this a lot. And that seems to be a handy indicator. Okay, I think this is important. It's an indicator of price behavior. It's not an indicator of value. Okay, we always need to differentiate between the two. I'm using these technicals as ways to kind of get better entry points or exit points. That's all. Okay, the fundamental valuation is the most important thing. This hopefully will help me get that little bit of extra juice of outperformance over time. I usually use the 1 or the 5-year moving average. That's just what I use. Other people will perhaps use a different time frame. I think those are the most important when we're looking at price behavior. So here's an example, just randomly using the US dollar index. And so you can see here the price movement and the up and down, okay, in the bar charts there. And then you'll see the 200-day moving average is this thicker red line that slopes upwards at the moment because of the average closing price has clearly been higher over, I believe this is a 1-year 200-day moving average. Okay, so it's just plotting the average, and then you'll see that start to come down, which will slowly bring the average down with a lag, and that's what you've seen here. Okay, that should be fairly straightforward to follow. MACD, what is that? Moving average convergence or divergence. Okay, so what you got here are 2 averages. Okay, exponential moving averages. That is important, but we won't really go into it too much today. You've got 2 moving averages that are being tracked, and you're working out when does one converge or diverge from the other? When do they cross over? Probably, I would say the most common is the 12 and 26-day moving average. So you've got the 12-day moving average being tracked, and you've got the 26-day. When do they cross over? That's what traders are looking for in terms of this pricing pattern. So you can jump on Investopedia. They've got some great easy info. What you're looking at here are 2 things. You've got a baseline here, and you're looking for where these curves, how far do they diverge away from the baseline? Okay, so how far do they move away from trend to the upside on a run or to the downside on a pullback? The other important points would be here if we look where they intersect, okay, and cross over. So normally people are looking for when the 12 minus the 26, when that starts to, the 12 starts to cross over the 26, it's suggesting that that recent moving average is going up. Okay, it's higher than the longer dated 26-day moving average. And so it might be the case that the stock's on a bit of a run. It's receiving more buy orders than sell orders. And so they starts to bid up the stock. Okay. The converse would be true in the other example. Okay. And so what else do we need to point out here? If we see some of these strong vertical movements to the upside. Okay. So you can see what I imagine there. It doesn't say, but I imagine there that is the 12-day breaking through. So it's crossing over the yellow line, which again, I believe is should be the 26. And you'll see also the bars here indicate the amount of volume coming in. And in this case, they're bidding up the stock, and the distance between those moving averages and the baseline. So this baseline would measure the general trend. And this has gone a long way to the upside, suggesting a breakout. Okay, in this case to the upside, and then down here you would see the opposite to the downside. Okay, so 12 here is the blue line and 26 is the orange line, just to confuse things in my trading view. And so you know now the DXY again, same chart with the 200-day moving average. If you see, again, the distance between the lines here, tracking the moving average and the baseline, shows how strongly the trend is being moving, in this case, to the upside. And what traders often look for is this blue line breaking through the yellow line to the upside. So that 12 breaking above the 26 often signals a breakout. Then you'll notice it comes back down. So depending on whether you're a momentum trader or value trader, they'll wait to see how far it closes back towards the trend. But they might decide then to pull back and wait until you get the next crossover. That's a lot of people use that as a buying signal. Okay. And then on the downside, let's take a look. So the 12-day crashes down. That's often used as a sell signal. And because it means the most recent, the 12-day moving average, is dropping below the 26-day. So it's losing momentum in terms of capital inflows. That's the way I think of it. Hopefully it makes sense to you. And that's starting to coincide, as you can see here, with a downtrend in the price of the stock. So if you were to offload it here, theoretically, then waiting here to see it almost bust through, but it doesn't, and it has a sharp sell-off. Okay, so you would have done quite well if you either had gone short or exited a position or chosen to wait as opposed to buying in. And over here, it has been fairly reliable in terms of signaling good buying entries. So it's just another thing to take into consideration. It's not the be-all and end-all, in my opinion. And then we see that follow through to the downside. It never recrossed over really, and then reverted back to the baseline. And then we had a sharp drop down in the opposite direction, which matches up here with a decrease in price. Okay. Okay. RSI, relative strength index. Okay. The way I think of this is the measurement of the strength of moves. So not just whether something is going up or down in terms of the average, but on one day, is it shooting to the upside by a large degree, or is it just slowly moving to the upside? And similarly, is it shooting to the downside on big price moves, or is it slowly moving down? Okay. So again, I think it's almost always used in 14-day periods, so 2 weeks, and then it's just put with 100 and 0 being the range bound. So the way that people look at it is, if you're getting to above 70, it means, or it suggests that it's being overbought because that particular asset is moving up in very, very strong moves. So instead of going up by, 0.5% per day, it might go up 1, 4, 5, 10, 20% per day, is depending on the case. And similar thing on the downside. Okay, if it's below 30, it means that it's had a really sharp sell-off, and it might potentially be used as an indicator for either a top on the upside above 70 or a bottom on the downside. So here, this is what it looks like, this purple section down the bottom. So this is the US currency index, a Dixie again. And so you can see it for this particular index, it had very sharp movements to the upside. Okay, you might remember the US Fed went on a real rate hike spree, and the dollar strengthened and started to throw everything into havoc last year. And so you can see that reflected here in the RSI. Okay, and then what's important to note is when it starts to come down, just means the movements are cooling off in terms of the magnitude of the price movements in either direction on the day. So as you can see, it's formed over 70, being overbought, 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 overbought. And then potentially, if you were a short-term trader, you might look at selling call spreads out of the money. If you think that, okay, this move short-term has been done a little bit, I might be able to make a little bit of profit off a spread, potentially. And the reverse would be true for if it were to break down to the downside. I think this chart really reflects it well because it's one I've been speaking about a lot recently in the Options Mavericks publication. This is Transocean. This is a fascinating stock to watch. It's like watching a TV show when the market opens. And my buddy Jordan, who you'll know if you're a squad member, we just go back and forth texting all day, watching this stock. Sometimes it's quite crazy. So from here, this 200-day moving average that we spoke about was an excellent entry point to add exposure, because look where we had the 12-day burst through above the 26. So that was another potential buy signal. So we've got two from three so far. And then we start to see the RSI tick up sharply until we get above 70. Okay, so as you can see here, this is a beautiful crossover on the 12 and 26 day. And with the support of volume underneath, for me, I really like that in terms of a momentum play. And given the degree at which it's above the baseline, again, suggests that it might be a good opportunity if you haven't already got exposure to get in, or to add to your exposure until you start to see the move get away on you, where you'll start to see that cool off and you'll start to see the RSI come back down below 70. All right. So that's it, guys. Hope you enjoyed that. Any questions or comments, leave them in the comments section, and I look forward to catching up with you in another video shortly. Take care.